And so as I've discussed just before, once you have the cash flow statement done as much as you can, in any full-scale model, the next logical step is to look to the balance sheet to say, how can I build this? But you can't build it because you have an incomplete cash flow statement. So you need the depreciation schedule and you need the working capital schedule. But those schedules are based on historical balance sheet information. So in a financial model, like what we did with Walmart, you look to the last reported year balance sheet information, the PP&E for the debt schedule, current assets, current liabilities, sorry, for the depreciation schedule, current assets and current liabilities for the working capital schedule. You can build those schedules, finally have a final cash flow statement, balance sheet. In a merger model, we can't just look up the historical information for the acquirer and the target. We have to create a merged historical balance sheet that we can use to drive the depreciation working capital schedule and all the other schedules. This is done through the process called balance sheet adjustments. So I'm going to fix this. And it is important to go through this several ways because balance sheet adjustments are often just memorized. And if it's just memorized and you don't really understand the concepts fully, then you'll never understand how balance sheet adjustments should be when looking at one-off or different transactions. I see that a lot. Or even as an analyst, I see associates looking at balance sheet adjustment tabs from other models trying to replicate it, and then they'll say, okay, well, we want to do the spin-off or something different. And they'll just stare at the balance sheet adjustments for hours and cannot figure it out because they don't understand the concepts of why it works. They're just memorizing where the movements are. It's important to understand why balance sheet adjustments work because you'll be looking at different types of transactions under different scenarios. The balance sheet adjustments is basically merging the acquirer and target balance sheet, but is driven from the sources and uses of cash. Much like how cash drives the balance sheet, cash coming in from outside of the balance sheet in a transactional setting, the sources, cash comes in from outside, and where cash is going in a transaction, the uses, will drive the adjustments to a balance sheet. Because what we're going to do is we're going to take the acquirer's balance sheet, and we're going to take the target's balance sheet, and we're going to line them down side by side, and we're just going to add them together. And everything about the acquirer and everything about the target, you add them together. And if you add a balancing acquirer model and a balancing target model, that's going to give you, obviously, a balancing combined model, but it won't capture anything dealing with the sourcing and using of funds. And in order for the transaction to be complete, we have to place everything that relates to the equity and debt that we've raised to pay for the transaction, and everything that relates to what we're using that money for, the uses. So let's begin. Let's look at the uses and sources of cash. Uses come in three categories. What? Tell me. Purchase price and net debt and fees. And the sources come from, let's keep it simple right now, debt, equity. Okay? Sources and uses. And the adjustments are based on those sources and uses of cash. The balance sheet adjustments stay in balance if each and every use is properly adjusted for in the combined balance sheet, and each and every source is properly adjusted for in the combined balance sheet. And so the way I like to look at it is I'm going to have pluses and minuses that represent what gets added to the combined balance sheet and what gets subtracted from the combined balance sheet based on the sources and uses of cash. And so before we begin, we have to demonstrate sources and uses of cash as balance sheet line items so we can interpret them on the balance sheet. So for example, the purchase price. How do you represent the purchase price on a balance sheet? What does the purchase price become on the balance sheet? This is probably the most difficult one and confuses people. How do you think about the purchase price?
The
equity plus
goodwill.
Yes, yeah. Awesome, good. It is the book value. And remember, purchase price above book value is goodwill and intangible assets. And some other things. I don't want to get into that detail yet. Oh, maybe I will in a second. But just simply, right? Your purchase price minus book value becomes intangible assets and goodwill. And actually, okay, let's talk about that for a second. Let me talk about this for a second. Back in the day, purchase price over book value didn't exist. Right? Before, in the 1800s, let's say, or the 1700s, when the stock market opened, late 1700s. There was book value. Right? Book value was the appraised value of assets minus liabilities. When stocks started to trade, the combined value, trading value of the stocks started to rise above and beyond the value of the company as written up by its books. The market value became greater than the book value. And that was fine. But when you start to get into buying businesses, the debate became, well, what happens if the purchase price is greater than the book value? And why is the purchase price greater than the book value? Well, the purchase price is greater than the book value, of course, because you have to convince these shareholders to give you their shares, and you got to pay a premium. You're not only paying a premium above the current stock price, but the current stock price is already a premium above the book value. How do you account for all that? And they said, let's just plug it. That's basically what it is. And call it goodwill. It's goodwill. It's an old 1800s term. We're paying higher in good faith, whatever that means. Sits on your balance sheet, does nothing. Provides no benefit to anybody. Gets written off at some point. Actually, up until 2001, you were able to amortize goodwill. You can amortize it over 15 years. So in the heated M&A activity of 99-2000, people started to take advantage of that. How do you take advantage of that? The aggressive auction processes of tech businesses, 99-2000. A lot of fund managers or strategic acquirers kept saying, I'll pay 100 times more for this company because I don't care. I can amortize all that goodwill and get tax deductions. I'm going to save taxes. And to the SEC, they were gaming the system that way. SEC, it's not fair. We can't have you pay an enormous amount of money just throwing money at these companies, and that means the government is giving you back money for that. That's got to stop. That's what happened. Somebody, whoever it was, made a legislation saying we can't have all this goodwill out there. Goodwill can no longer be amortized. If you're going to pay more for a company book value, that's on you. That's not on us. We're not going to give you tax deductions for that. That's basically where all that came from. So there's a rule that came out that said goodwill is no longer amortized. Okay, but people started to complain. People started to complain because they said, well, listen, I get about the exorbitant amount of money that a lot of people are paying in an auction process. But there are reasonably good reasons why a company would pay more for the purchase price than its book value. One is we have to. One is the company trades higher than book value. What about that? We're not forced. We can't pay below the share market price. Another reason is, well, there are actual definable reasons why I'd want to pay more for a company than what it's worth rather than just the aloof, I want to win in an auction process. Like, I'd rather pay more for a Coca-Cola delivery company than a delivery company that has no brand to it. The brand name reaps value, and maybe the company that I'm buying for didn't properly represent the value of the brand. I want to justify reasons for paying more for a book value than what it's worth, aside from it being goodwill. Just said, all right, fine, you can you can eat into this from 4 specific categories. One is the allocation to intangible assets. You can say, all right, the reason why I'm paying more for the company than what it's worth is because I believe the brand has not been properly represented. There's no value for intangible assets. And what I'm going to do is when I buy this company, I'm going to get an intangible asset appraiser, I'm going to get a lawyer, I'm going to go and I'm going to have them value the brand and say, this is the reason. It's not just goodwill. This is the reason why I'm paying more for the book value than it's worth. I want credit for that. The other reason is the write-up or down of PP&E. In other words, I actually believe this company wasn't diligent enough. It didn't do its own due diligence about what is properly is reasonably worth. And I think if I came in and had an appraiser come in now, the property is worth more than what they've been stating on their books. Why does that disconnect happen? Just the company just hasn't reappraised it. So I'm going to get a tangible asset appraiser and go in and see if the assets of the business have not been appropriately appraised. And if it's found out that the assets of the business are undervalued, then I want to attribute the reason why I'm paying more for the business than what it's worth is because the assets should be worth more. The other category is deferred tax assets and liabilities. And the simplest way is if I write up assets, I depreciate those assets. Sometimes you accelerate depreciation to create a deferred tax liability. If I write up those assets, I might have more deferred tax liability. The rest is goodwill. So really what happens is your purchase price over book value is not really goodwill. It's this purchase price over book metric. You take that purchase price over book and you subtract the allocation to intangible assets. You subtract the write-up, write-down, PP&E, and the deferred tax liability. Now, everything left over from there, that's goodwill. It's anything that you can't allocate anywhere else. That's the true goodwill where it is now. So that's why purchase price over book minus book value minus intangible assets minus write-up, write-down, PP&E minus deferred tax liabilities, anything left over is goodwill. That's the new goodwill. For now, we'll keep it simple. We'll just do, and usually you really just because the whole write-up and write-down of PP&E, that never happens to the very end. And then, of course, naturally, that implication of deferred taxes doesn't happen to the end, getting appraisers in. But we usually do, as analysts, assume conservatively like 20 to 25% of that purchase price over book is allocated to intangible assets. Why? Because most of the time, companies get away with that. All right, just 20 to 25%. Usually, they allow that. So as analysts, we just take as a first cut 20 to 25%. Anything else, any of these other adjustments, we usually don't deal with. But we will model them in Office Depot, Office Max, just so you can see how it works. Okay, that's my goodwill conversation, and we'll repeat it in some form. You don't have to know all of that. Oh wait, actually, again, you do now. Yeah, you do. Somebody got asked about purchase price allocation in an interview, a guy from the last group. This is purchase price allocation. Where does the purchase price go? If you ever get a question on an interview question on purchase price allocation, this is what they want to know. Where does the purchase price go? Intangible assets, write down PP&E, deferred tax assets, liabilities, and the rest of the world. Purchase price allocation. Okay, I guess that's an upcoming topic. Yes?
Is there like a definition for the goodwill? Like how to interpret in the English?
The purchase price over book value or goodwill?
Goodwill, like in finance.
The undefinable reason for why, the undefinable reason for accounting purposes for why a company would pay more than what it's worth as its book value.
So this is A minus B.
Okay.
But there's no concrete.
It's a plug. That's what you're saying.
definition?
When you say concrete definition,
Give me like a reputation. It's company reputation.
no, changes from company to company. Yep. And it's not the company reputation, because the company reputation should be then intangible assets. That should be brand to that. There's goodwill should be the unknown. If you can say, well, it's because of the company reputation, it's because of this, then that should be allocated in intangible assets or somewhere else. If you cannot say it's goodwill, it's literally the unknown. So, purchase price can be represented as the book value, intangible assets, and goodwill, combination of all three. You add these up, this will equal your purchase price. The book value plus intangible assets plus goodwill. Net debt, how do we represent net debt as balance sheet line items? That's easy. What kind of debt? Target long-term debt. Let me just say, this is target book value. Let me be specific. Target short-term debt. Target cash, I'll put in parentheses because it's minus target cash. And the sources is acquire debt and acquire equity. Simple. Okay? Now that we've interpreted.
Well, debt is all kind of debt that target has, like it's not only long-term, short-term, I mean all kind of debt.
All long-term, all short-term. Like what other kind of debt would there be?
Maybe they call it differently.
Okay, but it's all under the category of long-term and short-term.
How do we treat capital leases if we have something like?
Yeah, it's a long-term. Yeah. But capital leases you might not pay down. You know, you can break that down into detail. Everything.
We can revolver? No, we don't.
Sure.
We capped it?
Oh yeah. Everything that we spoke about, when we spoke about net debt, we're talking about enterprise value, right? All of that is included in short-term, long-term debt. Capital lease obligations, non-operating liabilities, the revolving line of credit, all that stuff. But we did net debt with Walmart. Everything. Non-controlling interests, no. Just like that. Okay. So, how do we interpret now these individual line items as adding or subtracting from the combined balance sheet? So think about this. So we're going to take the acquirer's balance sheet and the target's balance sheet, and we're going to add them together. And when we do, we're going to make adjustments based on the uses and sources of cash. Some of these line items will be eliminated. Some of these line items will be added, but we have to account for all of them. So my question to you is, which line items will be eliminated? Pick out one. Pick one. What is that?
You're consolidating the books.
Yeah.
Debt and equity.
Debt and equity. Whoa, no.
Target short-term debt and target short-term debt.
Okay, no equity. Okay, well, what do you mean equity?
Target
Pick one.
debt.
Debt. Which one?
Target.
Oh.
Long or short?
Oh.
All.
All. Target long-term debt gets eliminated. Target long-term debt. We will eliminate. Target short-term debt. We will eliminate. I'm drawing this in the elimination column. Target cash. We will eliminate. Okay? What else? We've handled this. We've handled that debt. What else? What about equity? Target equity. Target book value is represented by target shareholders equity. Will be eliminated. Every single item in the shareholders equity section. The retained earnings, stock, prefers, gone, bought out, eliminated, wiped out. What else? What's added? What's added to the balance sheet? The issuance of new shares, new equity. Should acquire new equity. What else?
New debt.
New debt. What else?
Goodwill.
Goodwill is added.
Intangible asset.
Intangible assets created. Okay. So you want to think about what's going on from a higher level. You are paying off the equity. Shareholders going away. Paying off the debts. Lenders are going away. And you're replacing that with new debt and new equity. However, there's a problem. The value of the debt and equity that you're raising to reflect the purchase price is more than the book value. Because you're paying for a value that's more than the target equity. What is that made up of? That's made up of a combination of goodwill and assets. It's goodwill and assets. So what's going on should start to come together conceptually, but in order to understand how to handle that line by line, you have to look to the uses and sources to determine what adjustments to make. Now we left out one specific thing, and that's transaction fees. What happens to transaction fees? And this is the last line. This won't balance until you've handled all of them. Transaction fees are typically paid out at the close. We didn't talk about timing here. Remember, with the income statement and the cash flow statement, we don't do historical income statement and cash flow statement because, let's say in this case, we're gonna give the example of the company was merged December 31st, 2016. If the company is merged on the day December 31st, 2016, we won't see consolidated financials until 2016. We'll see full projected year consolidated financials. But you will see a balance sheet, a 2015 balance sheet, because a balance sheet is at a specific point in time. You will see a December 31st, 2015 balance sheet. That's what we're creating here. We're taking 2015 acquired balance sheet, 2015 target balance sheet, and adding them together and merging them. And we'll see that. And so the point of that is, in transaction fees, even though we don't see 2016 fees, or 2016, sorry, even though we don't see 2015 net income, those fees are paid upon transaction close, which is December 31st, 2015. So this becomes a little bit of a conundrum kind of thing, right? Where, okay, well, this should be fees kind of hit net income. Fees are an expense, but I'm not going to see 2015 net income. So where does net income plug immediately? Retained earnings. So this impacts retained earnings. This is a negative impact to retained earnings. This will reduce retained earnings because it hits net income immediately. And that is exactly what will keep your balance sheet adjustments in balance. And it's so important to understand this roadmap, because this is what a lot of people memorize, because these are the standard adjustments. But what happens if something is different? What happens, for example, if you don't pay down the target net debt? A lot of people get confused. This is where people sit and stare at this round. Well, if you know how to draw out these roadmaps, you can easily see, well, if I don't pay down net debt, then I don't make these adjustments. And then you follow the hours, and I don't pay this down, I don't pay this down, I don't pay this down, and then you're back in balance. So you have to draw these out for each transaction that you're doing to make sure you're keeping it in balance. And so you have this in the slide. Check it up. So you have for your records, and it's in the book. So the book kind of walks through it step by step. And we'll do it again for Office Depot Office Max, and we'll do it again for the leverage buyout. But this is on a slide, and it's in the book. I'll give you the reading tonight, 78. Okay. Heather, you got a question?
Yeah, how about asset? Like the asset is also gone, right? The asset of target company.
That you keep. The assets?
Right.
When you eliminate all this, what you're left with are the AR, accrued expenses, right? Current assets, working capital, PP&E, the operating assets of the business. Presumably that's what you want. Everything else you get.
Okay. So you only eliminate things that you.
Okay, guys. Notice instead of pluses and minuses, I have debits and credits. I'm trying to change the process on this, but I don't want to put you guys at risk. And I've seen this as standard on Wall Street, where instead of pluses and minuses, they use T accounting, debits and credits, where an increase in an asset is a debit and a decrease in an asset is a credit, yet an increase in a liability is a credit and a decrease in the liability is a debit. I think it's just so confusing. Yeah, why do they do that? So in the next model, I'm going to do plus and minus. Makes it simple. Just whatever you're adding, whatever you're subtracting. Let's do it both ways. Okay, so the first thing you want to do always is line up the acquire and target next to each other. Okay, so I've lined it up line by line in the template. I want to pull in cash and cash equivalents from the acquirer. Okay, 2015, it's the historical, remember, on the day. And I'm going to copy this down right quick. You could just do big Control D. Or if you don't want to mess with the formats, Control C. Hold down Shift. While holding down Shift, tap the down arrow to get all the way down to, let's say, retained earnings. You can go down to shareholders' equity, but we're going to be redoing the totals anyway. Actually, we're not going to be redoing the totals here. We'll be redoing the totals in the total column. And I want to paste formats. I could paste special, paste special just the formulas, which won't overwrite the formats, or Alt-ES, okay, paste special, and I just want to paste the formulas, Alt-ES, F, enter. Boom. So that's a way to copy down without overwriting the formats. Yeah, and you can do it again for the target company. Where I'll do it again. Equals target financials, cash, 2015 cash. I'm going to copy this formula. I want to copy just the formula down so I'm not overwriting the formats. So while holding down Shift, I tapped the down arrow and then paste special formulas. Alt-ESF, enter. Right? So, quick way to do it, right? Copy all the way down. What were you saying, Jim?
Did you send this template out yesterday?
This is the same model.
Oh, it's the same.
I'm sorry. Yeah, this is underneath the cash flow statement. Just scroll down.
Oh,
Sorry, guys. I should have mentioned that. Yeah, just right underneath the cash flow statement, we're at the balance sheet adjustments. Let me just go kind of overview. And there's several columns. One is the acquire column, target column. This is we're going to lay them out side by side, and we're going to make the respective adjustments in the total column. This will be our pro forma. This pro forma is after the formation, and that's going to be used as our final balance sheet to make projections, things like that.
Using Alt-ES.
Yep, and then F. Okay. You guys got that? Okay, then we want to set up the total column to be able to handle the adjustments that we're going to make. And so for every asset, it's going to be equal to the acquirer plus the target plus debits minus credits. Because with liabilities, it's the opposite. Acquirer plus target plus debits minus credits. So we will set this up in preparation. Okay? Got it? We can copy this down all the way through the assets. Okay? And just the one thing you have to do is fix the totals. Okay? The totals in the total column cannot total left right. They have to total top down, otherwise they won't capture the adjustments that we're making above. You have to redo the totals. It doesn't matter here because these aren't changing. But here they'll change. So total current assets, total assets. I'm going to clean this up here. I see these hanging zeros that mean nothing. I'll clean up these zeros here just from the way I copied this down. Okay? Let me save this model. Okay? Need another minute? For liabilities, it's going to be equal to assets, acquirer plus target, minus the debits, plus the credits. And copy that down. And you want to also just redo the liability sum formulas so that they sum top down. This is what you should have. Take a couple minutes and get there.
What did you say the formula for the liability for the total?
Minus debits plus credits. Okay, and shareholders' equity is the same thing as liabilities. It's the same formula. It's acquire plus target minus debits plus credits. Okay, and copy that all the way down. And again, make sure your totals are totaling top down. Stockholders' equity is the sum of the above. Liabilities and stockholders' equity is the sum of the total liabilities and stockholders' equity. Otherwise, the adjustments that are captured that we're going to make won't be captured in the totals. This combined balance sheet should balance, obviously, because the individual balance sheets balance. We haven't done anything to change that. Let me know that you guys are there before moving on and making the adjustments. Okay. Now, does everyone have that? What adjustments should we make? Where should we begin? Doesn't matter. What do you think? Wrong. No. Yeah, let's do debt. We can wipe out debt and equity. Let's eliminate target debt and target equity. Let's start with eliminating target equity. Let's wipe out target equity. So I want to mark off what we're doing. This is the process. New equity. So undo. Can't undo. Oh, there goes my highlighting. Okay. I want to wipe out all shareholder equity items. This one, which is represented by the target book value. Let's wipe that out. Okay. Represented by each line item that make up target shareholders equity needs to be eliminated. The way we're going to do that is we're going to have F debit eliminates the shareholder equity. We're going to have F137 equal to E137. That's the way we're going to do it, which effectively wipes it out. That might seem redundant. In other words, why do you have it on the, why do you have it in column E only to remove it again? Why bother doing that? That's because if we end up updating the way it flows, if you think about the way, if we end up updating the target model, which you might have to do as time goes on, it'll flow all the way through. You're not interrupting or disturbing any of the source information. That's why it's done this way. I don't know why. I guess it's just the nature of that I did slideshow. I don't know why on the screen. I see. Now I lost my arrow. Okay. This is what you have. And I'll put this in, this should be in black font, these adjustments. Okay? So we're left with the acquire preferred stock. We wiped up the target. Okay? Let's do the same for each and every line item that relates to the shareholders' equity. We are wiping out everything related to target shareholders' equity, leaving us with the acquirers. We bought out the shareholders. Shareholders done. Do you have questions on that?
Sorry, I think I missed this. You know your liabilities and equities, that formula, is it different from the assets? Oh, it is, okay.
Minus debits plus credits, right?
Correct.
Yeah, stop it, flip it.
So then everything can happen on one debit card.
For this particular adjustment, yes.
Our sum should be the sum of that column. Don't do the same minus and
Yeah,
subtract.
it's different from minus and plus. Normally minus and plus would have sum. And then from the minus we have negative.
Yeah, no, this is the way it's done in the bulge brackets. Yeah. I agree. I don't like it, but you got to be done. You got to be taught the right way.
Yeah, this is the right way. Debits and credits.
I don't like it this way though too. I prefer the pluses and minuses. Yeah, I prefer the way. And hope, I don't know, maybe firms are starting to adapt that. I hope so. But okay, let's also wipe out the components of the target company net debt. We're assuming the target company's net debt is gone. How do we know that? Because the uses are representing that. Okay, so short-term debt, gone. Long-term debt, gone. Cash, gone. So much for the target short-term debt, target long-term debt, target cash. Wiped out. Okay? So, in the model, we will debit out we will debit out the long-term debt. Oops, wrong. Debit out the long-term debt. Debit out the short-term debt. Okay. Done. Done. And credit out the cash, because when you get to the cash side, it's the opposite, right? You're going to credit out the cash. Removing cash is a credit. I'm going to credit the cash account. leaving us with just the acquirer's cash and net debt because the targets we've paid off. Credit. Any questions?
You scroll down.
Yeah. This is what you should have here. It's not going to balance. Is that what you're checking out? Yeah. It won't balance yet. Take a couple minutes, get caught up. We've wiped out. We've paid off. Target's equity, target's debt. Gone. So here, if you see on the slide, we can now, so we've eliminated the book value, the debt. We have sources that we can take on. Okay? We can add in the acquirer's new debt. We can add in the new equity. How? I inadvertently crossed it off in the beginning. That was a mistake. The equity and debt come from the Assumptions tab. Let's put the equity in as common stock. Let's assume that they're raising stock at their share price. That's going to come in. That'll be a credit. We're going to credit in from the Assumptions tab common stock. Got it? Up it goes. Okay? And we're going to credit in, let's assume that they're taking on long-term debt. Long-term debt. They've raised the long-term debt. They've raised the equity. They're using those funds to pay off the uses, to pay off this net debt which you've done, to pay off the book value. But what's missing? The value of what they're raising, 4,200.7, is greater than the book value, which is only 934.5. And it's greater than the net debt. It's greater than what they're funding. Why? Goodwill. Why else? Fees. Why else? Intangible assets. So hopefully you can start to see how this is coming together. So we need to account for goodwill. Do you guys have these adjustments? Need a minute? Take a minute. Questions? No? Got it? Getting it? Yes, Jing.
We talked about the credit we raised is 2 times 2000.
Yeah,
That include the cash of 700.
No. No, the cash is part of the net debt. So really, I don't know if this is what you're asking, but the actual representation, I just simplified, is this is what you're paying for. It's this plus this plus this plus this plus this plus this plus this minus cash, right? Net debt. Oops, what happened there? Yeah, minus cash. The cash is part of net debt. That I simplified just to illustrate. This is what we're comparing to. So 972.7 is being funded by these two. Where is that difference? That difference is the fact that we didn't include the fees yet. We didn't include the goodwill. We didn't include the intangible assets. Once we put that in, it'll all match up.
Oh, so it's included in the first like long-term debt.
Yeah.
Long-term debt includes 900 or 700.
The net debt. The net debt. It's in the net debt. The 5 plus 3 minus 761.8 is represented here as 38.2. Once we link this up, I'll show you how to do it in different ways. Ricardo, this is the assumptions tab. I don't know why the purchase price would be off. Okay, so what's the next adjustment we can make then? We just discussed we got 3 left to put in. What could 1 be? Goodwill, intangible assets. Notice, and in the Office Depot Office Max, we'll build a more robust box that can handle all the purchase allocation categories we discussed before, deferred tax assets, write-ups and write-downs. But for this simplicity here, we're going to assume, here's the price over book value. We're going to assume 25% of that will go to intangible assets. The rest is goodwill. So there's several ways to do that. I'm going to go to the consolidated financials. The way I'm going to do this is, first of all, we're going to go to intangible assets. This will be increased. This will be debited. We have a new account based on 25% of the purchase price above book value. So this is going to be equal to, from the Assumptions tab, price over book times 25%. Okay? 25% of the purchase price over book value will increase our new intangible asset account. Got it? Make sense?
So the reason why we compute this from the income statement is because we have divided that by the number of years.
Yeah, the income statement is just the amortization. We want to book the total amount. In the future, we'll see, now that this is on our balance sheet, this will go down, down, down by the amortization. That's what we'll project next week. Good. Good distinction. The remainder is goodwill. So you can take the purchase price over book value minus this, or I think a more robust way to do it, here's the goodwill box, is going to be equal to the 3128 times 1 minus 25%. 1 minus. So that way, whatever percentage we have, it's the reciprocal. It's the opposite of that. 1 minus times, in parentheses, 1 minus the 25%. Okay? That's the goodwill. In other words, the sum of the goodwill and intangible assets is 3128. That's the purchase price over book value. 3128 is the purchase price over book value. Okay? Got it? So we have what's next? We have effectively handled correct. We handled equity. Gone. We put that on. We added that. Debt, we added. Goodwill, we added. Intangible assets, we added. So again, This is where it's important to be able to draw these things out. If you're doing some transactional situation where your uses are different than what you see as standard, you know to adjust the roadmap that you're drawing here. We'll see this with the Office Depot, Office Max. What's left? Transaction fees. That's the missing component. Once this is in, our model should balance. How do we handle transaction fees? Retained earnings. We will make an adjustment to retained earnings. So we're going to go down to retained earnings. Here it is. We're going to reduce it further. So we're going to make another credit. It's on a another debit. It's on a credit. But we're already debiting out 204.5. We're going to add to that an additional debit representing the value of the fees. So right now you're going to see we're not balancing, right? So we'll balance once we do this. So already cell F141 equals E141 plus on top of that we want to make an additional reduction where our fees of the 100. Once we do, we should balance. We've properly handled every balance sheet adjustment. Save. Does that make sense? F141. And this should make sense. Some other ways to look at this, Jing, I don't know if this is what you were asking, but what does our purchase price represent here? What's the purchase price? Of these line items, how do we back into the purchase price? We can do it.
Versus equity does that. Wait, now, sorry.
Nope.
Book value of equity plus goodwill.
Yes. Do you understand that? The purchase price is represented by the book value plus the goodwill plus the intangible assets. Does that make sense? Because the purchase price minus the book value is goodwill and intangible assets. If you pay more than the book value, that goes into goodwill and intangible assets. So you can back into the purchase price by taking the book value plus the goodwill plus intangible assets. 41625. Is that the purchase price? Okay. One adjustment to be made. The fees are in there. Okay, that's the purchase price plus the fees, right? I should have, yeah, the fees are in there too. Purchase price plus the fees. If I took 204.5, then that would represent the purchase price. It's inflated by 100 because the fees are in here as well. The fees are in here as 304.5. This is purchase price plus the fees. Okay, so that gets to my next question. What are total uses? It's the purchase price plus the fees plus what? Plus the net debt that we've paid. So let's add, so this is already purchase price plus fees plus short-term debt plus long-term debt minus cash gets us to total uses, right? 400%, let's make sure. 400.7. Good. That's funded by the sum of these two that we're raising to pay for that, 400.7. That's what we're doing. We're bringing this into the balance sheet and we're eliminating everything else. That's the way you should be thinking about debits and credits. Do you have questions on that? This all represents the final balance sheet we will use to build the rest of the model. As I mentioned before, it is this model, or it is this balance sheet, that will give us our final PP&E that we can use to calculate straight line depreciation. And we have CapEx, that's acquire plus target, that we did yesterday, that will help us calculate accelerated depreciation. It is this measure of current assets and current liabilities that we will use and back into to build working capital. Then we'll have depreciation and working capital to finally complete the cash flow statement that we have here, fill in all these yellow holes except for short-term and long-term debt, but enough to be able to project our balance sheet based on the cash flow statement. And then the last piece is the debt schedule. We'll have a good indication of true accretion dilution. And we hope, well, in a 100% equity case, we've predicted, based on the assumptions, that this will be dilutive. Ricardo, where are you off? I'm going to send this now. Do you have any questions?
There's some.
Huh?
Like the beginning, my I was balancing, and then I went back and looked at I didn't.
The sum formulas?
Yeah,
Okay,
yeah.
Ricardo, that's a good hint. So Bharat had trouble with his sum formulas. I mean, that's something to check. Yeah, definitely want to be summing top down, because if you're, it's right. If as I mentioned in the beginning, if this is just this plus this, it's not going to capture the adjustments. So. Okay, good. So perfect stopping point. Next week, the focus is just to complete the rest of the model. It's very similar now. From this point on, it's pretty much like a standard model. So repetitive for some, great practice for others. But at this point, building blocks is going to be a little bit of repetition. I'm going to try to continue to make it creative. And that's the focus of next week, getting this template model done, and then talking about how this differs from the Office Depot Office Max, and we'll take it from there.